Does higher risk equal higher returns? I've spoken with over 1,200 investors one-on-one, high net worth people. This question comes up a lot. If an investment's return is higher, does that mean that it has higher risk? And I will say the answer is sometimes, but not always. And that's why it's really important that you pay attention, you look at what the downsides really are, look at the advantages and disadvantages of a particular investment. You might find things that are actually not high risk, that have much higher returns than what you thought was possible. So we're gonna jump into this. We're gonna have a great quote at the end. Go ahead and smash that like button, and we're gonna jump into it. Okay, so as we get started, let me make a disclaimer. I am not your financial advisor. I am not a financial advisor. I used to be one. I'm no longer one. I'm not giving you advice on what you should do. I'm simply sharing my opinions. This is educational. Just have to get that out of the way. So the first thing we're going to say is, what is the link between risk and reward, right? So some investments that are very safe, one of the most safest investments that has been said is the treasury, short-term treasuries or T-bills, which are typically a few months out, backed by the federal government, the US government. That's considered a very safe investment, right? I have my own debate on why I think maybe that's not the safest investment, but in general, that's common knowledge. The return for those investments are typically fairly low. You're gonna get a very, very low, if any, it's just gonna be very nominal. Sometimes you have negative interest rates on some of this stuff. And then you get to things that are gonna be higher yield. So a similar type of investment would be like a junk bond, right? So a corporate bond, a group that's paying money, it's gonna be a much higher rate than a T-bill. Now, why is that? It's because, well, these junk bonds, the company typically has had some financial trouble. They had to borrow in the first place to be able to get the bond. And so there's a decent chance that they may not be able to repay it, right? So you can see the risk. It's pretty much easy to see. I will say this, that a lot of things, though, are not so cut and dry. It's not exactly what you see is what you get. Now, if you look at this image here, just take a look at it for a minute. Now, what do you see? Some of you might see a young woman kind of looking over her shoulder. Somebody else might see an older woman who's looking at us. If you stare long enough, you can kind of see both. But again, we can see things kind of for how we see them. We don't always see them the way that they really are. And that's how it comes when it comes to looking at deals. We don't always see things from the exact way that they really are. We have our own bias, our own background, the own things that we bring into that. And it is really important to just note that and look at that when we're looking at different deals. So a question that comes up is, is the market, in the sense of the market for any deal that we're looking at, is it efficient? I mean, is it accurately priced with all the risk kind of packaged in there, and it's always completely efficient and accurate? There are a lot of people that believe, a lot of really smart, brainy people that are much smarter than me that believe that that is true. But I will say there are also some very smart people that do not believe that. Warren Buffett, he has a saying that says, price is what you pay and value is what you get, right? So you can go to the store, you can buy a sweater. Let's say I want to buy a new sweater, and I can pay $100 for it, or I can get it on sale and pay $50 for it. That's really kind of what good investing really is. Warren Buffett says good investing is like trying to find a dollar and only paying 40 cents for it. Now that might be kind of a strange concept. Not everybody can get that and understand that, but it's just not always that you pay more and you get more for it. And I've seen that. In some cases it's true, but a lot of cases it's not. Now this can happen as well, where we've seen this, right? Where the stock market will value one stock at $100 one day, and then a week later or a day later, that same stock that was $100 is now valued at $10, right? Well, that's confusing. Like, which is it? Is it $100? Is it $10? Well, somebody who's an efficient market person would say, well, that's all accurate, right? The risk, everything was priced in here, everything was priced in here. But the truth is that the market is not efficient. There are deals that are out there. And if you're someone like me, I love getting deals. I love traveling. I get travel deals and going to Eastern Europe next month on a trip, really looking forward to that. And I got a great deal on the flight, right? I like getting deals. So I think it's important that we look at and say, there are deals that are out there. If somebody is really into this efficient market theory, if they were going on a walk and said, hey, here's $20 on the ground, if they really believe in efficient market theory, you'd say, well, if it's really $20, it wouldn't be on the ground, right? It wouldn't be there. Like, why? But in our world, we don't live in a perfect world. The world is very inefficient. There are different reasons why there's different deals that are there, and sometimes different asset classes. So we work in multifamily real estate investing. I'm going to get into that in a minute. The returns are substantially higher than things like the stock market or other things if you look at a long-term historic basis. Now, why is that? A lot of times you have, at least the type of deals that we do that are value add and other sorts of things where we're doing improvements, they're not liquid, right? That's a disadvantage of investing in multifamily real estate, at least these syndicated deals. Typically, people's money is tied up for 2 to 5 years, right? So you can't just like a stock go in and trade it and get it in and get it out. And so there's a disadvantage to it, but the returns generally are higher. It doesn't necessarily always mean the risk is higher. All right, so the second thing is that higher returns can actually mean lower risk. And I'm going to get into an example here that's going to show you that that is true. Now, my background is investing in multifamily. This is our business. You can use this with other sorts of investments as well. It's really important that you look at the pluses, the advantages, and the disadvantages and the risks of every investment. Because there's always going to be things that are great about certain investments, at least most investments, and there's going to be things that are going to be risks about every single investment. Any investment that says there's no risk there, you should just turn tail and run, because every investment has risk, right? So I'm going to share a multifamily investment about why some things can be higher risk, but not necessarily be, they can be higher returns, but not be higher risk. So like I said, multifamily investing, some of the advantages are we see much higher than the stock market as far as returns. It's not uncommon for us to see 15% or higher per year returns, which are great, right? And if you look at the historical growth, you can see that pretty evident in the performance of different groups, our group as well. And how does that happen, right? How do those returns actually happen? Well, one of the ways and one of the differences between this and investing in REITs, which are financial kind of more liquid assets, is that we have something called a value add component, right, that's used. So we come in after somebody moves out of an apartment unit, we come in and we'll spend $10,000. We'll come in and we'll renovate that unit, and we'll be able to raise the rents by a couple $100s for the next folks that move in, and they'll have a nice new renovated unit, and that dramatically increases the value of the property. So you don't get that when you invest in REITs or other types of things. So the returns are going to be higher with this type of investment typically than looking at other types, even other real estate types of real estate investments. Another benefit is with multifamily real estate is that we're able to use leverage. We're able to use debt. So we'll put 20-25% down, sometimes less, and that if a property appreciates in value, the equity still is not a higher proportion of it, but we can really dramatically increase the value of the property. One example of this, we have a property that we bought less than a year ago in Jacksonville. It was $27 million. It was a 288 unit property, large multifamily. We actually sold the property for $37.5 million less than a year later. And obviously there's reasons why that happened. The market appreciated. We got a great deal on it. There's things that are kind of outside of our control on some levels. But the side that's really interesting is because we had leverage in that, right? We didn't pay for the whole thing in cash. So even though it only increased by 20-30% in value, or whatever that percentage is, maybe 30% or so, we dramatically 70 to 100% increased the equity that was invested, which is just phenomenal, right? So there's some real upsides there. Another benefit is that there's a real inflation hedge when it comes to investing in multifamily. You can see on this chart with just rent growth over the years generally rises with inflation. It just kind of generally goes up, right? If you look at kind of inflation and you look at this chart, you're going to see it's very, very similar as far as what happens, because there's an inflation hedge kind of built in, which is really great these days. My opinion about inflation, that it's not going to stop. It's here to stay. And being in inflation protected assets is actually really valuable. So those are a few advantages of it. Some disadvantages of multifamily, or some risks, I would say, is, like I said, that you have some illiquidity, or you can't just go tomorrow after you invest in a deal and say, hey, I want to get my money back, right? I mean, the sponsor could buy you out. They could say, okay, sure, and that does happen. But in general, it is more illiquid. It's typically 2 to 5 years or so until you get your money back, or maybe money's coming back, but before you get your principal back. So that is a risk, that if you need liquidity, you need the money sooner, then that would be a disadvantage, right? Now, the disadvantage is it's very operator dependent. So it depends who you invest with, right? If an operator is a great operator, it can perform phenomenally well. Or if they're an okay operator and something goes wrong and maybe they don't know how to deal with it, there's some risk there as well. So there's some risk of who the person is that you're dealing with, and how reputable are they, how comfortable are you with them. Those are all things, and we have some videos that talk about really vetting a deal and vetting an operator, and that really is the most important thing, and especially in this type of deal, is who you're actually working with. Another kind of risk or a concern in multifamily is, what are the rates? Well, what are the rates that we're getting on the debt that we have, and is it fixed or is it flexible? If you have an adjustable rate debt on it, or it switches at some point after a couple of years, and you just have to kind of go to the market and say, I want whatever rate you're going to get. If you're at a 3%, all of a sudden you've got a 5 or 6%. That could really affect the performance of the deal. So there's some different risks there. It's just really important that in anything you invest in, you have eyes wide open, right? So again, to me, I really don't think liquidity, especially if you have savings and you are well diversified and you have just money available outside of your investments, liquidity is not having liquidity is not the worst thing in the world, right? Because you're kind of hedged against inflation, which I think is great these days. But again, these are all things that you have to weigh out. So I don't necessarily look at those all as disadvantages. You just have to be able to understand them and understand and say, hey, okay, this is higher returns, but what are the risks? It doesn't mean it's necessarily higher risk of loss of capital. It just means it may look a little bit different. All right, so now we're going to talk about asymmetric returns. Now, what does that mean, asymmetric returns? What it means is that you have a high upside or a decent upside with a low downside. There's this great book out. It's called The Dondo Investor by Manish Prabhai. And it talks basically about this idea that heads I win and tails I don't lose much. And so you have a higher upside than you have downside. So when you evaluate your investments, it's really great when you have an investment that's like, there's a very, very high percentage chance that this will go fairly well. And there's a very low chance that this will not go well. And the issue is if it doesn't go well, it's not that you have 100% of your investment or your 100% of your assets in this investment. You're diversified, you have things around different places. But just the idea that you have a lot of upside without the equal amount of downside. If you do something and it's like, this is, I'll give you an investment, and if you invest in this, whatever it is, you'll make $100 million if it goes well, but there's a 50% chance that you'll die if you invest in this, right? Like, who would do that? It'd be a terrible, some people would say, oh no, I would do that because of this, but it's important that you evaluate both sides and that the benefits are substantially higher than the downside. And a lot of investments are that way. So really having something that's a low downside. And I will say this, a lot of people would say, hey, I'm well diversified, Bronson. I've got stocks, I've got bonds, I've got all these different things. Well, the challenge is that there's a lot of correlation between those things, right? So if you own stocks, if you own bonds, if you own just single family real estate, those things can be very correlated. And so if one goes down, they can all go down, right? We've seen stocks go down 30 to 50% over a 12-month period multiple times in previous years. Bonds right now I see of having a big time risk when it comes to the interest rate risk, right? So if you have a bond that yields 3 or 4 or 5% and all of a sudden these bonds come out that are yielding much higher rates, it makes your bonds, frowny face, worth much less than before, right? And so it's really important, again, that you look at what is the upside, what is the downside of a particular investment, networking events, conferences, talking with other investors, not just asking them about their best successes, but really asking about their mistakes, or where did they lose money, or what sort of operators or deals or things that did they do that they really just realized it wasn't for them. And that's really going to help you to grow, because the best investment that you can make is really in your own education. So well done for you for being on this video, because you're educating yourself on how to be a better investor. So I'm going to share this quote with you. I shared a little bit earlier, but it's just such a great quote. I want to share it again. Price is what you pay and value is what you get. And I hope, my friends, that you find value in places that other people say there is no value there, because that's really how people become very wealthy, is that they look for value and they find value in places where other people say it doesn't exist or it couldn't exist, or they just don't educate themselves to understand how that works. So if you're interested a little bit more about multifamily, kind of how it works, to understand more of the process, we put together this great video here about the unfair advantages of multifamily. It really is an unfair asset class, I think, because of the tax advantages, some of the other returns and inflation hedged benefits that are there. So check that out. I want to know in the comments below is, how do you evaluate risk in your deals? What sort of steps or what sort of diligence, what do you do to try to mitigate that? And again, thanks for taking the time to watch this. If you're interested in more videos on investing, inflation, what is happening today in the world, check out this playlist, and look forward to seeing you on the next video.